Hello everyone, my name is Craig Johnson. I've met many of you in New Orleans. Acceptance Capital has asked me to head up the reverse mortgage platform to stimulate this sector of our business. And what you're about to see is a 2-hour continuing education seminar for realtors that is designed to help you access this market and in the easiest and most professional way that we can consider. I hope you enjoy this presentation. If you have any questions, feel free to call me or email me and we can talk about your concerns at that time. Thank you all for watching.
Good morning. I'm Karen Johnson with Acceptance Capital Mortgage. We're here to conduct a seminar on reverse mortgages for realtors. The person conducting the seminar this morning is Craig Johnson. He's the manager of reverse mortgages for Acceptance Capital. We hope you'll find it informative and very conducive to conducting business in a new and different and professional way. Thank you for coming.
Good morning, everyone. Thank you all for coming. We're here today to talk about reverse mortgages and how a realtor could better understand a reverse mortgage and help their clientele in a vastly emerging market of seniors who are entering this stage of their life in unprecedented numbers. Now, before I start, I'd like to clear the air a little bit about reverse mortgages. Many of you in the audience have heard things that make you a little leery or a little suspicious about trusting a reverse mortgage product. And if any of you in the room have concerns like this, I think this would be a good time to address those forthrightly so that you could feel more comfortable about it. Now, I understand that a couple of you have those questions, and let me start with you, Bob. What was the question that you had?
What happens to my children's rights after I pass away?
Okay, that's a very good question. That's a question that many people ask. One of the things people do not have a crystal clear understanding is that you own your house, not the bank, not FHA, not HUD. All the incidents of ownership of a piece of real estate stay with you. If you die with a reverse mortgage, your heirs are going to have some decisions to make, but in all candor, they would have those same decisions if you died with a forward mortgage. The first thing I would urge your heirs to do would be to have the property appraised. Remember, you would have taken this mortgage out many years before your death. So let's assume that you owe, at your death, $200,000 on your reverse mortgage. And let's assume that after the appraisal, your children find out that the property is worth $300,000. In that case, your children would be better off probably to sell the house for $300,000, to pay the real estate commissions and closing costs generated with that. For a $300,000 property, I think you'd have about $25,000 of cost there. Probably between $16,000 and $18,000 going to the realtor for commission, and the $4,000 or $5,000 the seller's closing costs would be. So if you subtracted that from the $300,000 you got from the house, your heirs would wind up with about $80,000 in equity from that house. Now, let's take another example. Let's say that the house only appraises for $325,000. Well, you're going to owe pretty much $25,000 when you sell the house between the commissions and the closing costs. In that case, your heirs may say, I have no interest in selling it. I'm going to give the keys to the title company and walk away from it. The heirs have no obligation to the property. A reverse mortgage is a non-recourse loan. And what non-recourse means is that only the property secures the debt. They can't come back and say, we're short, you owe us $50,000. If the loan exceeds the value of the house, there is no obligation for anyone, any member of your family. So it's a very safe loan for your heirs. Now, There's a couple other things about reverse mortgages that make it even more compelling for your family. The family is granted the right to buy your home at 95% of its appraised value, regardless of what the loan underneath it was. So if your loan, because you lived a long time, if the reverse mortgage debt was $400,000 and the house appraised for $300,000, you could still buy the kids could buy that house for $290,000. Now, I'm not suggesting they would necessarily want to buy the house for $290,000 unless it has some intrinsic value to them, or they're being well advised by a realtor that this is a very temporary dip in the value of this property, which it happens, for example, in Florida all the time. There's peaks and valleys in Florida like no other state in the country. So there may be reasons for the kids to keep the house. Remember, they'll be reverse mortgage eligible themselves at that time. But the fact of the matter is the only way we know the answer to that is to ascertain the value of the house. Because the house is going to respond to market pressures in every local area. Your house may go well beyond $300,000. It may go to $600,000. When I was a kid, my dad bought a farm in Richfield in 1965. He paid $59,000 for it. He sold it in 1990 for $650,000. I'm not suggesting you're going to get that kind of equity growth in your home, but certainly equity growth is a factor in this and needs to be ascertained clearly. So I can't tell you precisely what your heirs are going to get out of your house, because I don't know how long you're going to live before you pass it on and what the value of the house is going to be at that time. But that's a frank and honest discussion of what your heirs' position would be. Does that help clarify it for you?
Yes, it does.
Thank you. Now, Lonnie, I understand that you have a question about reverse mortgages also.
Yes, I do. I would like to know, do you charge an interest rate?
Yes, we do. The bank makes money charging interest. But how the interest is passed to the borrower is interesting because there's no mortgage payment that combines principal and interest. The interest collected on a reverse mortgage is a charge. And I'll try to make an example of this so that you have a clearer understanding. Let's just say, for the sake of this example, that you have a $100,000 reverse mortgage. And for the sake of this example, the interest rate is 5%. Each year that you live with a reverse mortgage, $5,000 is going to go against the value of your house. Now, the $100,000 reverse mortgage is not going to be the value of the house. It's going to be the amount of money you've taken out of the house, like a credit line. So let's say your house is worth $250 when we do this. So each year, $5,000 is going to be a lien against that $250. So in 10 years, $50,000 will come out of the equity of this house to repay the bank. In that period of time, which we would hope would happen, is that $250,000 value, maybe in 10 years it might be $300,000. We won't know that. How real estate values grow is very subjective, but I think it's fair we can assume in many good markets, in 10 years, a house that was worth $250, 10 years later is going to be worth more than $250. How much more is speculative. The point of the matter is you would have to live a very long time in order for the 5% credits against your property would be above the value of the property. You'd have to live for probably at least 30 or 40 years for that to happen. So let's look at a scenario there. Let us say that as a single person, you take that mortgage out. And you take it out when you're 73 years old, and 14 years later, you pass on. So we would have $70,000, 14 times 5%, against your your property that was worth $250,000. So your heirs would appraise the house. They would find out the house is now worth $325,000. They would pay the $70,000 off, and they would keep the balance. Does that answer your question, Lon?
Yes, it does.
Okay. Any other questions?
I have another question. I heard from a friend of mine that she had a friend that had a reverse mortgage, and when her husband passed away, that she had to leave the home, move out of the house. So what happens if your husband or your spouse passes away? Are you still allowed to stay, or
Okay, the answer to that question is an unequivocal yes. A reverse mortgage contemplates the life of both the husband and the wife. So if you and your husband would take out a reverse mortgage, the reverse mortgage lasts until the last surviving spouse passes. There is no exception to that rule if both of them are borrowers. Now, in order to be a borrower, you have to be 62 years of age and you have to live in the house. Those are the two requirements of a reverse mortgage. There are times when one of the two spouses does not fit that simple equation. We have many, many scenarios where the husband is 64 and the wife is 59. That 5-year age difference is not a surprising age difference in couples. In fact, it's no longer surprising when the wife is the older of the two. The fact of the matter is, in that scenario, unless the reverse mortgage is carefully created, the wife could be at risk. And here's how we take steps to make certain that doesn't happen. The first thing we do is we ask at closing for the wife and the husband to both certify that the younger spouse was married to the older spouse at the time of closing. So in other words, we're establishing her inherent property rights in that home. The second thing we're going to do is we're going to certify that at his death, the younger spouse was also married. Now, if that's the case, the wife has established her absolute right to that property as part of the dower and courtesy statutes in Ohio. She does not benefit for some of the other properties of the reverse mortgage, which are increased credit line availabilities, but she would have a lifetime interest in that home without ever making a mortgage payment. So if she were 82 when her husband died, and she lived another 9 years, she would not make a mortgage payment for 1 month of those 9 years. So she cannot be thrown out. The only way she could be thrown out would be if she no longer lives in the house as her primary residence. The federal government, which supervises these loans as carefully as they supervise any other loan, mandates that primary residence is defined as 6 months and 1 week out of every year. So if she's living in the house for six months and a week, she's the primary resident of that home. The only other thing that could cause her to lose eligibility would be if she has to go to a nursing home, or she has to move in with a child and is no longer the resident of the home. The only other thing that could happen is if she dies. So in any of those scenarios, she lives in the home. One of the things that happens a lot of times, somebody breaks a hip. We see broken hips in elderly, 88 and 89-year-old borrowers a lot. With a broken hip, there's going to be a stay in the hospital, and there's going to be a convalescent stay after about a week in the hospital. That convalescent stay might run 7 or 8 months. If your doctor signifies to us that she's going to be moving back to the house, that's good enough for us. So there could be a scenario where a non-chronic health issue comes up that has to be dealt with. Those people are given a year to move back in the house, and we can write 3 270-day further extensions of that. So in that scenario, really, the wife is very well taken care of. I want to emphasize here that I consider a reverse mortgage to be about the safest mortgage a person can take out. Bob, when you take a forward mortgage out when you bought some of your properties, what was the most likely reason that you would have to foreclose one of those properties?
Well, if I lost my job, my income,
That's exactly right. Somebody loses their job and they can't make the mortgage payment. So the failure to make the mortgage payment drives that foreclosure. Divorce could also enter into that. Loss of job, divorce, two biggest reasons. In a reverse mortgage, that is almost impossible to happen because there's no mortgage payment. So even if you lose your job, there's no mortgage payment that you have to worry about making. The only obligations a reverse mortgage borrower has is, number one, they have to pay the real estate taxes. They have to pay the insurance on the property, and they have to pay any maintenance that's required of the home. That would be the exact same position you would be in if you owned your home outright.
yeah, but I at this stage I have to be 62 years of age, right? I mean, if I lost my job when I was 30 years old, that would not apply to me.
That's true. You're absolutely right, but a 62-year-old person could still be working. Doesn't happen often, but we see people now working into the early 70s all the time. So the fact of the matter is their employment status in a reverse mortgage is essentially a non-issue in a reverse mortgage, where it would be a huge issue in a forward mortgage. Before you can apply for a reverse mortgage, you are required by the FHA and HUD to take a counseling course about reverse mortgages. That counseling course is issued by a certified HUD-approved counselor, and there aren't many of them. In the entire state of Ohio, there's only 4 agencies that do reverse mortgage counseling, even though we have a huge population of people. The only states where there's an ample resource of reverse mortgages are Florida and California. There are many states in the West where there are none. In that case, you do a 45-minute phone conference with a counselor who gives the lender a certification that the couple has completed the course and understands the basic issues of a reverse mortgage. That's before you even apply. All the other guidelines of FHA and HUD are inherent in the application process. The disclosures, the truth in lending statements, all designed to protect the borrower from an unscrupulous lender. The third thing is, unlike any of the other mortgages, you got no mortgage payment. So the fear of the mortgage payment being a real heavy burden on your shoulders. Did I take too big a bite out of my budget? Am I going to have enough money absent my mortgage payment to live, with some of the other things that are important to me are simply not in the equation. So when you have the kind of protections that we have, and the fact that the freedom from the mortgage payment makes it almost impossible for you to have a scenario that would wind up in your home being foreclosed. The only ones I could think of off the top of my head, if you didn't pay your real estate taxes, theoretically, the taxing authority could put a lien on that property for failure to pay the taxes. And if you continue to ignore their threatening phone calls, they could actually initiate foreclosure action against that house. Now, if you got a $400,000 house and you got a $20,000 tax bill, it's very unlikely that home is going to go to foreclosure. You're simply going to pay the $20,000 of tax, maybe get a home equity loan or something, and pay the tax bill. If you don't pay your insurance, if you own your home outright, you can't be foreclosed for that, because that's your decision. There's no one who has a security interest in your home where the lapse of the insurance would put their collateral at risk. You'd be foolish not to insure your property. But in fact, if you owned your property outright, you could not be foreclosed. In a reverse mortgage scenario, you're buying the insurance to protect the lender's interest as well as your own. If you lapse the insurance, you could threaten the loan. Do you see that? And the third thing is maintenance. Well, I know you, but you may not speak for every senior citizen out there. Most seniors are very conscientious about maintaining their property, but some aren't. There's nothing that we can do as a lender to verify that you're maintaining your property. We can only prevail upon you as a responsible homeowner. You got a leaky pipe, you fix it. Short of those three things, there's no way you can be foreclosed on with a reverse mortgage. So when I say it's the safest mortgage out there, I think I'm on pretty credible ground. And the principal reason why that is true is very simply, there's no mortgage payment to begin with. So you don't have any risk of losing your home because you can't make a $1,000 a month payment. Lonnie, do you have another question?
Yes, I do. If you have a reverse mortgage, what if your children want to move in with you? Can you charge them board? Is this all right with the bank? I mean, you can.
Absolutely. Not only can you do that, Lonnie, but I'm going to show you an example later where a customer actually buys a rental property. And not only do they not pay a mortgage payment, but they collect the rent. This is your house. All the incidents of ownership, this is no different than you taking any other mortgage out. When you buy a house and you put your 20% down or you put your 10% down, the lender has no interest in you if you have kids living there. In fact, in many scenarios, you got kids under 18 living in the house anyways. The question of whether you charge them a room and board fee is entirely up to you. The thing, though, I do want to make sure you understand clearly is that a reverse mortgage is designed for an owner-occupant. So you can't use a reverse mortgage to pay for a rental property unless you're living in one of the units of the rental property. In that case, you can have a 1 to 4 unit rental property. So if you could buy a 4-unit apartment building with a reverse mortgage, you live in 1 unit, you could rent the other 3 out, and that rental income would be 100% yours. Does that answer your question?
Yes, it certainly does.
Okay, now I think I'm going to go ahead and start with how a reverse mortgage can help you as a realtor enhance your professional standing in the community and identify markets that you can take advantage of that you're probably largely ignoring right now. There are a number of things that have happened to seniors over the last decade, which I call the perfect storm. And I want to start talking about what those things are. The first thing that has happened to seniors that were never contemplated by any of them is that in the early 80s, the private pension system in America collapsed. There's not a lot of press about this, but there's not a lot of academic study on it. But the simple fact of the matter is very few private enterprises now offer the classic pension plans that our grandparents or our parents expected as a right of employment. The only area in America today where there is a private pension system is in public sector employers. The police, the fire, city employees, state employees, federal employees have pensions. You work for a car dealership down the street, I got to tell you, you don't got a pension. It was the theory of the institutional thinkers about retirement plans was that the 401k plan was going to replace the private pension system. I can tell you, I've been in the mortgage business for a long time, and I've taken a lot of applications, and I have never seen a 401k balance that would support a retirement. Typically what I see is a $60,000 balance or a $80,000 balance. You're not going to retire on an $80,000 balance on your 401k. Would you agree with that?
I agree with that.
So the failure of the pension system is huge because many of us expected that pension system to exist the same way it existed for our parents and our grandparents. And really, we were well on our way through our productive years when in the mid-'80s and late '80s, this stopped. So the first leg of this perfect storm is there no retirement benefits other than Social Security. The second thing that has happened is that even if you have savings in a 401k or in a savings account and you diligently work for this, what is the interest rate you're getting as a return on that money? You put your money in the bank, what are you going to get as a yield from a certificate of deposit?
1%.
1%.
That's the best.
So if you got a $500,000 nest egg and you put it in a CD, what do you expect to get as a yield on your $500,000 nest egg? $5,000, 1%. You going to retire on $5,000?
No way.
What's your income going to be on $1 million? $10,000? Can you retire on $10,000? Senior citizens are getting brutalized by the fact that there's no return on their investments unless they take an equity risk with their principal. There are some stocks that pay dividends, and prudent investors do that. But by and large, people who are terrified about losing their equity in the stock market are eating peanut butter and jelly because they're getting a 1% yield on their life savings. Now, it would be different if when you and I were kids, we knew that there was a 1% yield on savings accounts. That's not the way it was when we were young adults. I would venture to say that everybody here confronting this by virtue of their age group was probably expecting a 3 to 5% return on their money. That was what the historical truth was. You'd walk into a savings and loan or your local bank and you put a savings account in, you got a passbook savings account. That passbook paid you 3.5%. That sound about right? And if you wanted to tie up your money in a CD, you'd make a little bit more money. Now, when you got a $500,000 savings account that yields 4%, all of a sudden we got a $20,000 income coming in as opposed to a $5,000 one. So just in interest alone, this borrower has lost 75% of its expected return on that savings. That is a brutal haircut. When you're losing 75% because the interest rates simply aren't out there, that is hard to replace. There's a million investment counselors advertising that they can help you plan your retirement. If you're 67 years old and you don't have $1 million in your savings account, you're not going to be able to retire comfortably unless you have some underlying pension. So the second leg of this stool is that there's no interest income for this group of citizens. So we got the first two we've already identified. No pension, no interest. That's a big 1-2 on its own. But there's more bad news for these people. There hasn't been a Social Security increase of any meaning since the middle of the Bush administration. 10 years. Every small increase in Social Security benefits has been offset by the Medicare Plan B premium that's gone up by the same percentage that your retirement income went up. You're no farther ahead. There has been no meaningful inflation adjustment. And really, if anything, the lawmakers in Washington are contemplating constricting Social Security benefits rather than expanding them. That's the truth. We're a very quiet aging population, but I got to tell you, there is a brewing civil war in age warfare in this country. Okay, so we got no pension. What a gift we have for these seniors. We got no pension. We got no interest. We got no increase in any of the benefits that you were fully taxed on every cent of the way when you worked, and your employer contributed the same amount of money you did. For middle executive employees or higher, that was $12,000 a year going into their Social Security account. You get a $255 survivor benefit. If you die, Lonnie gets $255. Boy, there's a great deal. Where do you sign up for that insurance policy? The other leg of this, and there's more than one leg left, has been the crash of equities in 2008, where a lot of these seniors took a real bath in equity loss. I can tell you from personal experience, my wife and I were virtually wiped out from this experience. But many, many investors lost a quarter of their equity value. So it's creeping up now, but they're just now getting even with that. So the loss of equities was a big loss for these people, because not only did they lose the interest on the money, but they lost the money itself. So there's another leg in this stool of the perfect storm. And the last leg is there's been no appreciation in home values for most communities in America in 10 years. It's not true in San Francisco. It's not true in New York, but it's true in northeastern Ohio, and it's true in most of the communities in America that we're just beginning now to approach the value that a home had 10 years ago. Every one of us in this room, by virtue of our family's experience and our experience in previous properties we owned, came to expect that if we bought a piece of real estate, there would be slow, consistent growth in its value. We weren't going to get 50% spikes in 1 year in Ohio, but we could easily expect to get a 5% spike every year, so that 10 years from now, you would have some equity in that house. That equity essentially dried up if you took out a mortgage in 2000 or 1995. It may have spiked up till 2004, but then it went right back down again. So the fact of the matter is that is what the average retiree homeowner in America is looking at. One of those legs on that stool has affected them, and likely more than one of them. In some cases, all of them have affected the borrower. So this is a rough hand that our baby boomers have got dealt. This is not a hand that they had any reason to expect was likely to occur. They didn't expect their home values to be flat. They didn't expect the pension system to be kicked right out from under them. They didn't expect that there was going to be a crash in the market. They didn't expect that there would be a flattening, a deliberate flattening of their benefits by the government. None of those, people blame the baby boomers for a lot of stuff in this country. But I got to tell you, there isn't one baby boomer out there that deserves this hand. This is a rough hand. And you as realtors have to understand that your buyers have been tainted with this brush. And their wings have been clipped in terms of the options that they have. Look, no one that you meet for coffee or meet at a club, your bridge club or whatever club you're in, is going to talk to you about the fact that I am really struggling to make my house payment. But a lot of them are. Now, there's two other things that really affect this deal. One of the deals is that by law, if Bob dies, his wife has to choose between his Social Security benefit and her Social Security benefit. They don't get both anymore. She's got to choose the larger of the two. There's no reason she would take the smaller of the two. So if she had a $1,000 a month Social Security benefit and you had a $1,800 a month Social Security benefit, she lost $1,000 of her monthly income on top of losing her spouse. That is a heavy gift from the government to your widow. She's lost 10/28 of her benefit. About 35% of her income has been lost. One of the things very few realtors or professionals talk about is that 32% of all retirees age 65 still have a mortgage balance. And the average mortgage balance for those people is $82,000. That means 3 out of 10 of every one of us walking around in that age demographics is carrying a $80,000 balance on a mortgage and trying to figure out how to retire. Remember, when that person took that mortgage out, it wasn't for $82,000. It was probably for $150,000. They paid on it for 20 years, knocked the balance down to 80, and still have another 10 years of paying the mortgage payment based on the original $150,000 loan. You with me on that? As your mortgage balance goes down, your mortgage payment does not go down. That's what an amortization schedule tells you when you borrow your money. So we got these customers with $1,200 house payments. They got the wife's benefit, the husband's Social Security, that's about it. You take the $1,200 wipes out one of their two benefits entirely. That $1,200 doesn't even include taxes and insurance. These people are house poor in droves. I'm not talking about one person out of 100. I'm talking about 1/3 of everybody you talk to has got this problem. They're not advertising it. There's no sign that says I'm a house poor on their back. But they're eroding their savings every month, trying to figure out what am I going to do 5 years from now when 3/4 of our savings has been dissipated to supplement our retirement income to pay the house off. We're going to be talking about this scenario in detail. I got a couple case studies about this. But this is the market. You have to understand that right now, approaching 40% of the population of this country is 62 years of age or older. they talk about the baby boomers being about 28% of the population. The baby boomers only encompass the years of birth 1946 to 1960. For every baby boomer turning 62 tomorrow, and boy, there's thousands of them, there's people who were born in 1945 or 1944 or 1943. These are still people who are healthy, active people. The fact is, though, they're not baby boomers. A person who was born in 1940 would be 76 today. I got to tell you something. The advent of increasing life expectancy with some of the miracles of medicine we've seen are remarkable. We extend the lives of our seniors. We don't necessarily extend the quality of that life, but we sure do make that extra 10 years out there potentially productive for these citizens. You have to be able to say to yourself as a businessman or a businesswoman who is a professional real estate broker, how do I identify these people that need counseling with me, because I can steer them in ways that will eliminate the problem of house poverty. And when you do that for your client base, you are not only selling some real estate and making some money at it, but you are offering a service to your clients that you could not match by offering them a home when they were 42. The final point I want to make on this subject is the 30-year mortgage is an incredible villain in this scenario. I see every day 51, 50, 49, 52, 53-year-olds. He gets promoted or she gets promoted. They're going to buy the last house they're contemplating buying. And would you agree with me that it was likely to be their most expensive home?
Definitely.
That's just the way it is, right, Lonnie? So they're probably going from a $200,000 house to a $350,000 house. They're going to look in a really nice community, maybe Hudson, maybe Aurora, maybe Bath. This is going to be the house they want their kids to get married in. They want their grandchildren playing in the backyard. Bob just got promoted. Lonnie's got a great job. Their accountant is saying, well, you need this tax break. Go buy this house. And they pay for it with a 30-year mortgage. The real estate community, I can guarantee you everything they have in their office promoting a specific lender or lenders in general is going to show what the rates are on a 30-year mortgage. That's the way it's advertised. They call us on the phone, the first thing we're going to quote is a 30-year mortgage. Why? Because it's the cheapest mortgage. And we're used to thinking that cheaper is better. So they take out a 30-year mortgage, and one by one their teenage kids grow up, and Bob's got to pay for weddings. He's got to pay for their college educations. He's not putting in the extra money in this mortgage payment. That's going to be what happens tomorrow. And then they start taking nice vacations, and all of a sudden that dream of paying down that mortgage is gone. In fact, it's more likely that he's refinanced the mortgage, adding more years on top of it. Now he's 70 years old. He still owes 60% of his mortgage balance. And he and Lonnie are looking at the realities of their retirement. They got the mortgage on the biggest house they ever bought. They got a $2,000 mortgage payment. Believe me, it's hard to retire when you got a $2,000 mortgage payment. It's hard to replace that income when you're earning 1% a year on your balances. In all reality, it's just not happening. Bob and Lonnie are now confronted with a simple reality. Bob's got to work. Bob don't want to work. Bob's got to work. You got any problem with the scenario I just outlined? Anybody in this room? Saul, I know you're thinking about this. Does some of this stuff strike a chord for you?
You're making my profile.
I hear that a lot, Sal. Honest to God, I really do.
You're making me depressed.
I'm sorry.
Some good news.
I'm sorry to be the harbinger of bad news, but the fact of the matter is, being well informed about bad news means that you can shore up your scenario to cure it. And we're going to look at in a few minutes a number of ways where people in this scenario have solved this problem. So let's take a quick break. Let me go out and get a glass of water, and then we'll continue. And I'm going to go through a couple of examples that will show you, as realtors, how you can help customers and how your customers can, for the first time, take a breath and say, honey, I think we're home free at this point. What a gift to senior. So let's take that quick break, and we'll continue momentarily.